don't forget. Now the ratios, how you guys doing? All right, the ratios fall into these categories. So don't forget, the ratios, they can be liquidity and efficiency. Okay, some deal with profitability. Some deal with solvency. And some deal with market prospects. And that's how you can sell your stock. Okay? So the ratios fall into these categories. Are they a measure of liquidity? Okay, like the current ratio and the quick ratio. Are they a measure of profitability, right? Gross margin ratio. Solvency, often this is debt to equity, but they're talking about, do you guys have enough debt? Is normally with the solvency. Is there too much debt? Is the right amount of debt? And then earnings per share and that sort of thing are the marketing prospects. Okay? And of course you take a look, it'll cover the balance sheet, income statement, statement of stockholders' equity, cash flows. Now, the standards of comparison. The standards of comparison. Sometimes they're intra-company. And I'm going to write CO for company and move along. And of course, intra-company, that means like it's a trend. Is it getting more profitable? Is it getting more liquid? That sort of thing. Okay? And take a look and see how you compare with competitors. You take a look and see how you compare with the industry. And of course, I've mentioned before, a great source of this, of course, is done in Bradstreet, because what they do is they have industry standards. And they break the industry down into quadrants and say this is the top quarter performers, the middle half, the lower quarter, and see how you can compare with other businesses in your same industry. And then there's guidelines. And the guidelines, for instance, a rule of thumb on your quick ratio. Remember, quick ratio is when you had liquid assets, like cash and those that are really liquid, compared to your current liabilities, and 1-to-1 as a rule of thumb is a good idea. And what that says is, if I have enough cash on hand to pay the bills that are due within a year, then I can survive an emergency, such as a strike or a national emergency. But that's an example of a rule of 1-to-1. As a general rule, the guidelines are probably the least reliable because it should change on your industry. Has everybody got the rule? Everybody? Okay, I'll put it right here. All right. And of course the tools that we'll do in here will be horizontal analysis. And horizontal analysis is comparing across time. And of course what we're talking about here are trends. So when you guys looked up your financial statements, most of them had at least this year and last year. Some went back several years. But that's an example of horizontal analysis. Are they getting more profitable, less profitable? Vertical analysis. And what vertical analysis does is like in the income statement, revenue, gross revenue is 100%. And everything else in that income statement is reported as a percentage of it. So if sales doubles, everything else should correspondingly double on an income statement. And if it doesn't double, there's a problem. Because, and of course what it tells you is you can have a lot of increase in sales, but if that doesn't turn into net income, it's pointless. So if your sales double and your expenses quadruple, that's a problem. And this vertical analysis will show you that because it will show all the expenses as a percentage of sales. And let me just introduce it now, and when we have an example, it will be a little more obvious. And then, of course, the ratio analysis. And of course, what will happen this chapter, as the course has gone on, 201 and 202, every chapter had ratios, right? And so you memorized them at that time. Now, this chapter contains all the ratios. And the ratios, of course, are broken into these 4 categories. All right, and be sure to know what category each ratio goes in. So let's start here with horizontal analysis. Okay, so with horizontal analysis, let me put this up from this is define this on page 690. And I'll go ahead and put it on the board and show you what an example of horizontal analysis looks like. So it's page 690. This is what we mean by horizontal analysis. Of course, it's across time. So, I'll put it up here now. I'll turn that camera around in just a second. And so, put this here. I'll turn the camera around and turn the lights out so it's more readable. Now, let me move this around. Now, while I have this here before I forget, if everybody signed the roll,
Okay, did you say that one?
the 690, yeah, I went ahead and no problem, be sure to ask.
The number is between,
What's that?
the number is between the book and the certificate.
What did I put
It's on
on that?
691.
Oh, 691. Oh, you're
Oh,
right.
there you go.
You're right. Let me do 690. Is that why you were asking? By the way, you know, I've learned in the past, it's always a good idea to be polite. Because I'll admit, Levi, when you said that, I thought, hey, this guy reads, look, I wrote it down. I thought that, I'll admit it. But then I thought, no, Steve, all you care about is these guys learn their stuff, don't get bogged down and be pitiless. So I said, wait a second, Levi, look, I wrote it here. And it turns out I put the wrong one on the board. Am I glad that I had the maturity to act like that? You guys let me a lesson, always act mature, because it can really come back to be a blessing. Because I'll admit I thought, look, it's written on the damn board. All right, so here's what it does. Now what this is doing, now by the way, the difference between 690 and 691 is the difference between an income statement and a balance sheet. So, and let me just put up one of each. So what you do now is you take this year, the previous year. So in this case, here we have 2009, 2010. So like cash and cash equivalents. In 2009, it was 835,546. This year, it went up to 1,550,861. So you subtract the earlier year from the later year to find the difference. So that means the difference is 715,315. Then you put the change, and this is the actual dollar amount, so the difference between this and that is this amount. Then you put this over the earlier year to get the percent of change. So cash and cash equivalents went up 85.6%. This is comparative analysis. It takes 2 years. It's a form of horizontal analysis because it shows how things change across time. Okay? And so they have a lot more liquidity. Now, don't forget you can be too liquid because what this might mean is they're not making the most of their assets. Maybe what it says is they should be buying some asset that they can put to work. Okay? Now, it was interesting. My brother Marty works for, he's been a vice president type position for large corporations for all his life. He was somewhere in middle management and then he's never been president of a national company, but you know, he's been vice president of some really big ones. Anyway, what happened was his company just was purchased. And I said, does that make you a little nervous? And he says, no. And the reason it doesn't is because the company that bought his company, and he said, it was, anyway, they did that as practice. So when he flies, because he's a big cheese, he gets to go into all these VIP lounges. So he was striking up a conversation with somebody there whose company had previously been bought by the same company that bought Mark's company. And what the guy said, as long as you guys are profitable, they'll leave you alone. Mark's company was profitable, they left him alone. Now, the reason it's in our conversation is, we took out the financial statements and started looking at his company, because it was the profitability that was the issue. I saw the balance sheet and said, man, you guys got a lot, man, the company that bought you, it has a lot of cash. And he said, yeah, they're getting ready, this is before they bought us, they were getting ready to buy us, and that's why they had so much cash. Okay, but this will tell you, because that's quite an increase in cash, you just wonder what's up with all the cash.
Why aren't they reinvested?
What's it, yeah, why aren't they buying something that'll make them money? Because cash doesn't make money, but why aren't they buying something that they can put to work?
Cash actually loses money, doesn't it?
Yeah, and inflation can eat it up. On any short-term investment like would be the cash equivalents, it's not making much interest. But again, what's with all the cash? Is the question you might, and again, there can be legitimate reason. Okay. All right, so that's a horizontal analysis. All right, so let's do this. So again, what you do is you find the dollar amount difference, put that over the first year to find the amount of change. Okay, this is what it looks like with the balance sheet. It's the same thing with an income statement. Okay, so this was the revenue in 2009, the revenue in 2010. As you can see, it went up by $3,888,038. Okay, but this over the first year, it was a 35.1% increase of revenue. Okay. Does that make sense? All right, let's do this. Let's do quick study, 17.5, page 715. Okay, here's how it reads. Then if you guys want to do that, so here's how it reads. What it says is, there's the top. So here they are. So what it is, all right, good, good. So here's how it reads. It says, compute the dollar changes and percent changes for each of the following accounts. So here's short-term investments. So you have 2010, 2011. So it went from 165 to 217,800. So find the dollar amount, put that dollar amount over the earlier year, and that will give you the percentage of the change. You guys want to do that? This comparative analysis, and you're just comparing 2 years. Okay, yeah, that's right. Okay, 694 is the balance sheet, 695 is the income statement. So what's happening here now? I think it's easiest to see with the income statement, because what's happening here now is the fact that, notice that revenue, so here we have 2009, here we have 2010. Notice that revenue is 100%. Now, cost of sales is 8,000, so what this boils down to, I'll get a marker here. So in this case, if you take 8,368,958, you divide it by 14,953,224, you will get 0.56 times 100 comes to 56%. So what it's saying is that cost of sales, and cost of goods sold is another name for cost of goods sold, is 50%, it was 56% of of revenue in 2010, and it was 53% in 2009. So what it means is, they're doing a good job of buying merchandise. Okay? Now, then you do the same thing with your gross margin. So what happens here with the income statement is revenue is always 100%, it'll always be the denominator. And of course, it's 100% in 100% because for revenue, it'll always be over itself. Everything else, this is the numerator, numerator, numerator. So what you can see is you can see how things are going. So what this can tell you is the fact that, do you know how expenses, everything's getting more expensive, prices are always creeping up. You know how that works? Well, when that happens, what you do is you just get used to it. But things can creep out of proportion. So if you double your sales, like your other things should also double. But it allows you just to see, make sure that nothing's getting out of proportion. So in this case, in 2009, the cost of sales was 53, but I reversed it, but in 2010. So the deal is, they're not doing as good job of buying their stuff. And of course, their gross margin goes down correspondingly year to year, year to year. Their research and development, those costs went from 6.2 to 6.5. Now the marketing got better, they got this cost down there. Amortization went up. Okay, litigation, okay, that went up. Income from operations, of course, went down. And then the investment income went down. Income before taxes went down, and so forth. But what it allows you to do, it allows you to keep track of how everything is comparing within itself. And it makes sure that nothing gets out of whack. Yeah.
So you're saying in this scenario, then, if you wanted to compare gross margin to cost of goods sold, that's what you'd be comparing on a vertical analysis?
No, what this is saying is the fact that in 2009, your cost of sales, which is the same as cost of goods sold, was 53.9% of revenue. And it increased to 56.0% of revenue in 2010. So what it means is they're paying more, they're paying a higher portion. And of course, then if your cost of goods sold goes up, then your gross margin will go down.
How are you showing that?
Well, in this case, your gross margin was 46% of gross revenue in 2009, and it dropped down to 44 in 2010. So that's what this shows. But of course, it would make logical sense, because in this case, revenue will break down into cost of goods sold and gross margin. So this plus this has to equal that.
Right.
So if this goes up, this goes down. Tim? Michael, before I go on, does that make sense?
Yeah, no, that makes
Okay,
sense.
yeah, Tim?
So basically, all the numbers coming down under revenue are numerators, and they all get divided by the revenue to get the
Exactly.
percentage.
Mm-hmm. Exactly.
Okay.
Mm-hmm.
And then certain ones have to add up to.
That's the only one that does it.
Yeah.
The other, it doesn't hold true for any of the others. And it just holds true for those the second and third one down, simply because of that, but that won't be true of any of the rest of these. Yeah.
And what does this ratio tell you?
Well, it just shows what it is. It's kind of the idea that it'll tell you, for instance, if your sales double, your expenses should correspondingly double, right? So if you sell twice as much, but that's hard to tell when you have odd numbers. So in this, and of course, it's hard to eyeball. So what you do is you take each of the items in an income statement, compare it to gross revenue, and we'll see how you're doing year to year. Again, let me back up, I don't think I'm clear here. It's the idea that any number by itself is simply hard to make sense of, right? So when you get this, let me get this. So when you get this number here, so when you get this 8,368,958, it's just hard to make sense of it. Well, here's one way of making sense of it. You compare it to revenue, okay? And so what happens is cost of sale, cost of goods sold was 53.9 in 2009, and then it went up as a portion of revenue to 56 in 2010. That means that you're not as efficient in buying. And that would have been hard to tell just looking at the raw numbers. So it means that you're just not, this is an expense. Expenses went up as a portion of revenue. So as a portion of revenue, they went up. And of course, the expenses go up, then your gross margin will go down. Of course, this is cost of goods sold, which is an expense. Yeah. And so what it means is, you gotta, if you own this company, you'd say, what's with the purchasing department? And it's just like, not exactly a red flag, but it's something you want to look into. And of course, does that make sense? All right, you guys doing good? Okay, let's practice this a bit, kind of get it down. And then, by the way, both the comparative analysis, the trend analysis, and the common size, the vertical analysis, all of those are menu items in most computerized accounting packages. So if you have QuickBooks, you can tell it to display the income statement balance sheet with this data on it, so you can see how your business is doing. And that's the beauty of a computerized system, is information that would have been tough to get before is now instantaneous. Michael, do I see a quizzical look?
Nope.
Okay, all right. So let's do this. Let's do exercise 17.5. But by the way, I had my notes here for me to do 2010. You guys do 2011, but I don't think that's necessary. You guys are pretty sharp. I'd be glad to if you want me to, but I think,
What exercise?
right here, exercise 17.5, page 17. So exercise 17. So here's how it reads. So here it is. That's quick study. Here's exercise. So here's exercise 17.5. Okay. Express the following comparative income and common size elements. So what it will boil down to is sales will always be the denominator. These will always be the numerator. And it will show you how it's working. So if you guys started with 2010, does this look like a good set of numbers? Feedback part of the way through? Yeah, Jonathan?
So for the second, the 47.6, how do you get that again?
Well, what you do now, in that case, you put 254,660 over 535,
And I usually 47.
and that should give you 47.6.
Then how do you get the 52.4?
Then it's this number.
Okay. Oh.
So
okay.
here's a
Okay.
pattern.
I get it.
This will always be the denominator,
Okay.
and each of these will be the numerator. And then it's 100% for the first year because the same number is both the denominator and the numerator. And again, all you're doing is you're just putting these things in context, because any number by itself just doesn't make any sense. Yeah. Yeah.
This is called vertical analysis.
In vertical analysis, and then it's also called common size.
Common size.
And by common size, it just means they have the common size in this case. All right, does that look like a good answer? So here's how they interpret this. Overall, this company said, so here's what we have. So sales is always 100%. Now, cost of goods sold went from 52 to 66, and that's more expense in proportion. And of course, gross profit will be 47 and 34, will go down correspondingly. The other expenses, they also went up, and therefore the net income was less than half. Okay? Overall, the company's situation is worsened. This is evident from the substantial decline in net income as a percentage of sales from 2011, 13% relative to 2010, which is 28.2%. The main culprit is the increase in the cost of goods sold as a percent of sales, 54 and 66. On a somewhat positive note, the company has not experienced as large an increase in operating expenses as a percentage of sales, okay, 19% in 2010 versus 21%. Even more positive is the company's level of sales increase from 535,000 to 720. Okay? And again, they've gotten larger, but it's that they sacrificed efficiencies in the process. Maybe it's just the cost of growth. Who knows? It's doing good. What we did is we dealt with an income statement. The same thing happens with a balance sheet. So if we have the balance sheet here, I'm going to put this back here so I'm mixing up these papers. So this was on page 6. So let's go to 695. So 695, except now the total assets is 100%. Now, if we take a look at the so now it's common size, and again, all you're doing here is you're trying to put things in a perspective, right? Because any number by itself just doesn't make any sense. So in this case, total assets is 100%, so this will always be the denominator. And of course, total liabilities and stockholders' equity will also be 100% because it's the same number, right? Because your total assets, 10,204,409, is the same as total liabilities and stockholders' equity, because assets equals liabilities plus owner's equity, right? So, total assets will always be 100%, and the total stockholders and owner's equity will also be 100%, because this will be the same number, because in each case, it's the denominator, and for that one, it's also the numerator. Does that make sense? Does that make sense? And so now everything else is the same. So your cash and cash equivalents, it was 10% in 2009. It jumped up by half in 2010 as a portion. So